Today, we will talk about alpha and beta in finance. Alpha is a term used in investing to describe an investment strategy's ability to beat the market, or its edge. Alpha is also often referred to as excess return or the abnormal rate of return in relation to a benchmark, when adjusted for risk. Alpha is a measure of performance, indicating when a strategy, trader, or portfolio manager has managed to beat the market return or other benchmark over some period. It is often used to rank active mutual funds and other types of investments. Alpha may be positive or negative and is the result of active investing. Alpha became more popular with the advent of smart beta index funds tied to indexes like the Standard & Poor's 500 Index and the Wilshire 5000 Total Market Index. Alpha is used to rank active mutual funds and is often represented as a single number, measuring how the portfolio or fund performed compared to the referenced benchmark index. The efficient market hypothesis postulates that market prices incorporate all available information at all times. Because beta risk can be isolated by diversifying and hedging various risks, some have proposed that alpha does not really exist, but that it simply represents the compensation for taking some unhedged risk that hadn't been identified or was overlooked. Alpha is commonly used to rank active mutual funds as well as all other types of investments. It is often represented as a single number and may also include Jensen's alpha, which takes into consideration the capital asset pricing model and includes a risk-adjusted component in its calculation. Two historical examples of a fixed-income ETF and an equity ETF illustrate alpha in action. The iShares Convertible Bond ETF had an alpha of 6.5% in comparison to the Bloomberg U.S. Aggregate Index, while the WisdomTree U.S. Quality Dividend Growth Fund, DGRW, had an alpha of 1.7% in comparison to the S&P 500. When using a generated alpha calculation, it is important to understand the calculations involved. Alpha can also refer to the abnormal rate of return on a security or portfolio in excess of what would be predicted by an equilibrium model like CAPM. Here are 3 key takeaways. 1. Alpha refers to excess returns earned on an investment above the benchmark return when adjusted for risk. 2. Active portfolio managers seek to generate alpha in diversified portfolios, with diversification intended to eliminate unsystematic risk. 3. Because alpha represents the performance of a portfolio relative to a benchmark, it is often considered to represent the value that a portfolio manager adds to or subtracts from a fund's return. Hope this would help. Thanks for watching.